Here's my very expensive legal disclaimer. Just about us. Like I said, we run a hedge fund, Praetorian Capital, 180 million. Come find me at Adventures in Capitalism. Sign up there, and I also have Kedem, which we'll talk about briefly. What we're doing seems to be working. Inflection investing isn't just a theory; it produces returns. And if you gave me $1 back when we started the fund in 2019, it's worth about $7 today net of fees. So very proud of how it's all going. And as our CCO likes to say, it's definitely not indicative of future results, though I feel pretty good about the future. What makes my fund different? I like to think of myself as an old school hedge fund manager. It's going to be volatile. It's going to be, contrarian. It's going to hopefully produce way better numbers than most other funds. Basically focus on being flexible, concentrated, absolute returns. We do a bit of event driven, and it's just a different sort of fund than what you see out there amongst a lot of funds. Inflection investing itself. Look, there's a lot of cheap stocks out there. Cheap is cheap. It is what it is. But the vast majority of cheap stocks stay cheap. The whole point is you want to wait for an inflection and catch that inflection. And I feel like a lot of investors just buy a cheap stock and hope someone notices it. And I'm really showing up when the situation is getting better. And basically the intersection of value and a catalyst is where the alpha comes from. Quickly, a shameless plug for Kedem. You should all go take a 4-week free trial. Go to kedm.com. What is Kedem? We're tracking about 25 corporate events and special situations. Inflections often come from corporate events, restructurings, spin-offs, bankruptcy exits, CEO change, privatization, activist campaigns. There's all sorts of things that unlock value and take a business that's really been suffering for a long time and set it on a new direction. And I don't know, I found Kedem has helped me flag a surprising number of special situations that really unlocked value. So I just want to talk quickly about where the hedge fund industry is right now, because when you think back to the 1970s, the Bruce Kupners of the world, those guys really made money, and today hedge funds are mostly underperforming, which is kind of sad, really, when you think about it. And the question is just, where the hell did the alpha go? I think this montage of nonsense is part of the problem. Everyone got themselves into a funny style box. They marketed it to allocators, and they can't get themselves out of the box. And the world changes quite rapidly. And to everyone who's self-styled as a microcap investor, I know it's kind of heresy, but don't just restrict yourself to microcap. There's a whole world everywhere. And I find way too many portfolio managers have sold themselves as being X and they can't do Y or Z. Otherwise, it's style creep. And the net result is they're just going to be structurally underperforming. And, I think the other problem is that a lot of people really are fixated on low volatility. If you think of the hedge fund world, a lot of these guys show up and they say they want to do 50 bips a month and then put, a turn of leverage on it. And the net result is they always blow up on every volatility event. And, I feel like the world of allocators focused on low volatility is just because guys have marketed them a product that's low volatility. And so, don't be scared of volatility. Volatility is good. Upside volatility is better, but volatility is part of the game. And finally, I tend to think that the vast majority of hedge funds really run marketing businesses, and they happen to own some QSIPs. It's kind of sad to see all these multi-billion-dollar hedge funds that effectively own Apple and Google, like my mom. Who needs 2 and 20 for that? But anyway, I kind of want to throw that out there just because I feel like our industry is all screwed up right now. But let's talk about inflections, because this actually works. The vast majority of securities are more or less appropriately valued. You take a drag and drop on Google or Apple or whatever. These computers can arb it all away and figure out what the right discount rate is. The opportunities come around corners, stuff that computers can't see. I like to talk about this situation. I call it the dead has risen, but it's a security that's just been underperforming for a very long period of time, not a couple quarters. I'm talking about a decade, maybe 2 decades. There's extreme yuck factor. When you tell your friends about it, they just look at you funny. When you tell your clients about it, you get fired. It's been kicked out of all the ETFs and indexes. So, a lot of the float is just, kind of ownerless. Portfolio managers can't own it. Like I said, the clients will laugh at them. And then some macro or corporate event, on one side, you have something like CADM, which will flag the corporate side. But on the other side, if you're dumpster diving, you'll eventually find macro events. I mean, if you take one thing away from this presentation, it's that the biggest upside comes when a situation goes from completely fucked to sort of shitty. And I just want to say that again, completely fucked to sort of shitty. That's where alpha comes from. Just kind of going back in time 2 years ago, remember the yuck factor? All these funds had to dump all their carbon. And I mean, think about it now. The best performing sector is carbon. I think we're in the second innings of this. Fortunes are going to be made in energy. And everyone pitching the ESG stuff to their clients is kind of a grifter. So anyway, that's kind of like enough about me. I kind of wanted to throw these things out and kind of set the stage for, the stock I want to talk about. And I want to talk about Lee Enterprises, because I think this is really fitting into the theme of something that's been totally left for dead, just forgotten by time, where things are really working. I mean, quick background, 115 million market cap, assuming it's at $19 a share, about 600 million EV. It's got tons of debt. It's less than one time EV to sales. There's a lot of upside leverage. And I think there's a really clear path to them getting to in excess of 150 million in annual EBITDA with less than 10 million in maintenance capex. And I think it's like 2, maybe 3 years into the future. And the main point I want to make is that increasingly large percentage of the EBITDA is driven by digital revenue. I mean, everyone likes to think of Lee Enterprises as a slowly melting ice cube of newspaper, and they don't notice what's happening on the digital side. So let's talk about digital here. Digital revenue on the left, it's accelerating rapidly. I think it's going to keep growing. Digital subscribers is also growing very rapidly. They're way ahead of their targets they give for 2025 on both categories. It's just rapid growth. You have to think back a bit. Most newspapers were run by journalists. They were horribly mismanaged. They literally charged people like my dad for the print version, and they gave the product away for free if you went to the website. The website was hard to navigate. It was a clunky, boring, bad product, and with minimal innovation. I mean, it's just crazy to think that in this day and age, there's still a factory that they chop down trees, they feed newsprint in, they print it, and then a bunch of guys deliver it to your house in the morning. It's insane to think about, and it's a reason that newspapers has always been a nice recurring revenue business, but a small margin business. As you go digital, some of the revenue peels off because you're not chopping down trees anymore, but your margins explode. And I don't think people have really realized that. And over the last few years, after the New York Times showed people how digital works, companies like Lee Enterprises have copied. They've built apps for your iPhone. They've made the product much better. And it's a sticky product. People want to know what's happening around them as long as the price is reasonable. And at about $10 a month, I think is very reasonable. Let's look at how the Inflection's working, though. Year-over-year growth, it's just there in the 50, 60 range consistently on the digital side. I want to show you this chart on the right. This is print versus digital. This is advertising. And whereas a subscriber won't cross for a very long time, just because, think of the cost of a print newspaper versus digital. But on the advertising side, they've already crossed. Q2 and Q3 are the first 2 quarters where the two crossed. And print is still declining, digital is growing. I like these sort of situations where you have like an X and a Y axis and they cross, and suddenly revenue is no longer declining, revenue's stabilizing, and then it starts growing. And once revenue stops declining, EBITDA is growing. Once revenue stops declining, people start looking at it and say, hey, this business isn't melting, this business is growing. And I want to show you, perfect comp, what I talked about in New York Times, but you can see where digital and print kind of crossed. I think you can see what the stock price did. And, it was a nice trade. And I think this is a very good comp for what's about to happen with Lee Enterprises, except for it's got, a bit more financial leverage, a bit more operating leverage, and it's substantially cheaper in valuation in terms of multiple on revenue. But let's play it forward 5 years. What is Lee Enterprises worth? You have a digitally native business. that's rapidly growing. I mean, in 5 years, I think most of the print will have been churned off, and just be a digital business. They're in the process of shutting down print plants all over the place and just forcing subscribers digital. You have an advertising revenue that scales with inflation against fixed SGA. I think people forget that in the 1970s, if you look at all the sectors that did well, everyone likes to talk that oil was the best performing sector, followed by gold. I mean, people just forget that newspaper was the best performing sector. It's just not in those those charts that people like to pass around. You have these regional monopolies with really deep moats. Most markets have one or two papers, but most markets outside of New York really have just one paper. You have trusted access to local consumers. Newspapers still, I mean, even while media has gone toxic in terms of television media, newspapers still have decent levels of trust. You have access to subscribers in a world where tracking cookies are going away. All these newspapers now can tell exactly what articles you've read, what your interests are. I mean, it's really a unique marketing function, and I think they're just starting. I really think a company like Lee is very much like Facebook right after the IPO, where they had all these eyeballs, they didn't know how to make money at it. And Lee is investing dramatically in tech and their ad tech, their whole tech stack. And it's holding back the EBITDA this year. But I think the net result is that they just make a ton more money. And it's a natural consolidator in an industry where a lot of local papers are owned by a family. And these guys can go in there with their tech stack, with their R&D budget, and buy these newspapers that are really struggling for pennies on the dollar. And I just think it checks all the boxes you want in a consolidator. We're consolidating the industry at like 2 times cash flow. And, of course, Chad from Reddit would tell you this deserves a SaaS multiple. I mean, it checks all the boxes as a subscription digitally native business. Does it get a SaaS multiple eventually? I don't know. We could always dream. But, I just think it's a unique time to own Lee, as advertising just crossed and it's likely to accelerate. Anyway, I think I got like 2-3 minutes left. If you want more information about me or my or Kedem, please subscribe.